Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Advanced Charting Techniques. And today, we're going to be talking about a study that's available on the Thinkorswim desktop platform that actually combines 8 indicators into one study. It's actually called the Ribbon Study. This is actually a study I was thinking about talking about, and I went back through our archives to look to see who else has covered this recently? It's been a year, and it was actually Ben Watson. Ben Watson's joining us in chats today. He's going to be providing assistance for anybody, for any questions that I can't get to, so he's exactly the right guy to have on board. Thanks for being here, Ben, but we'll set an agenda for exactly how we're going to cover the Ribbon Study in just a moment. But let me first of all say hello to everybody out there who's already chatting in on YouTube. Great to see Will and Ocean Life, David, Cody, Bob, John, High Speed, Brown, Buffalo, Life in the Fast Lane, Crispy, Kathy, Robert, Selva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, if you're just enjoying the recording of this presentation, enjoy that presentation, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Friday webcast series. And this one kicks off promptly at 1 Eastern time. We would love to have you here in the live stream audience. Now, speaking of Ben and I are also both on X. The best place to connect with your favorite presenters in between the live streams is on X. So if you have an account there, go give us a follow. You can follow Ben there at Ben Watson CS. You can follow me on X at Cameron May CS. We'd love to have you there as a follower. Ron G says, Cam the Great and Ben the Great. Yup, yeah, you got the right team here to talk about the Ribbon Study. But before we can do that, let me first of all make sure that we're aware of the risks associated with trading and investing. It certainly applies to charting as well. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's lay out the agenda for what we're going to be covering today. First thing that we always do is we go have a look at previous trades that we've taken in this webcast series. We do demonstration example trades. So we're going to be looking through our example trades and see how they're going. There's actually one that ended this week. Let's see how it ended. Then we're going to take a quick peek at the markets through what I call our trend value momentum lens, combination of 3 indicators that some might use to get potentially some insights into how the markets have been performing and hopefully how they might be performing. Then we're going to get into the Ribbon Study. I want to go at a pace that everybody can follow here because I suspect it's going to be a new study to most of you. Go ahead and chat in. Let me know, are you familiar with the Ribbon Study? Yes or no? It's also commonly known as a moving average ribbon. Whatever term you use, we're going to be talking about how it's constructed, and I am going to get very particular with this one. I'm going to show you exactly how it's built, and then talk through how it might be used to build a trade, and we're going to actually put in a trade today, okay? Bob's familiar with it. Great, Bob. Good to have you on board then, because I might ask a few questions leaning on the experience of some of the attendees. We'll see. But let's go right to the Thinkorswim desktop trading software platform. Brown Buffalo, no. Mike, no. William, no. Sharon, Cody, Kathy, Joey. Yeah, I figured a lot of you weren't going to be familiar with this, but there are a few out there. Mary, somewhat. Leon's, yes. Some. High Speed Low Drag says yes. Great. Well, let's have a look at our existing positions right now. Now, as of last week, we had 3. Why do we only have 2? Well, we have Apple and Google that are still active positions. One position is no longer active. That means one of our sell orders was executed, either the stop or the target. So let's go see what happened with PGR first. So let's go to, it's interesting, skipped over to tools. Did I click on tools? I guess I actually accidentally clicked on tools. Anyway, so here's Progressive Corporation. Let me load up our study set that we used to build this trade. So we're going to load up our PGR TTM squeeze and wave, using the squeeze as a signal, the wave as trend confirmation in 2 time frames. So here was the setup that we noticed with PGR. We had a series of the red dots that a trader might look to identify a squeeze. Once we change from a red to a green, that might be the signal. Boom, today might be the day. So at that point, the trader might look back over time since the red dot started and define a trading range. And then we just duplicated that trading range to establish a potential price target. And look what price has done since we entered this trade. We got our green trigger here. We were trading above the zero line on both our short-term and longer-term TTM wave signals. So took the entry, and the stock cooperated nicely, went right up to our target, went a little bit beyond it. We actually filled a couple of cents above our target limit order. So we're out of that PGR trade. That trade is done. Let's take off our studies and go have a look at our other positions. Let's see, Villager says the ribbon study is in your list of studies, but you haven't used it. Well, I can't fault you because we have hundreds of potential studies, right? So I try to cover as many as I can, but I'm only doing this webcast once a week, so it could take me years to explore everything that's potentially available. But let's go back to our monitor tab. We also have Apple. Let's go to our charts here, switch things up for Apple, see what's going on with that position. So with Apple, we have a stop down here below this support. We have a target up here at a previous high, but that wasn't entirely the reason for taking the trade. If we load up our study set here, let's load up our Apple 200 period simple moving average and the money flow indicator, money flow index. So with Apple, we saw that, yep, we were at a support area. Also coincident with a rising 200 period moving average. So for some traders, it might already have them suspecting could be time for entry. But at that same time, we also noted that our money flow index had accomplished something that doesn't happen very often. It actually reached an extreme low, the extremes defined in money flow index or MFI being below 20 or above 80. So an extreme low, and started to rise back up out of that just as we were bouncing off the support, bouncing off the 200 period moving average. So we took an entry, placed a pretty tight stop there. Didn't provide much wiggle room for risk. Now, still with a stop, we can get a gap down, take a larger loss. That's a possibility. But in this case, we started a rally, sagged back on a poor earnings announcement, and then we're rallying again, moving in the right direction. Now, we're not to our sell order just yet to the top side. So we might feel like we're winning at the moment. This is still a trade that could turn around. A trader, if it's within their rules, maybe they might look to possibly even start to take off some of the position at this point, because our entry was such a small dollar risk. We've actually already more than exceeded at least a 2, probably a 3 to 1 reward to risk unrealized gains at this moment. So we could, if the trader's okay with it, possibly even exit some of that position. If we were to exit, let's say half, maybe we'd be taking sufficient profit to even eliminate let's say counterbalance any losses that may occur going forward. So what do we think? Should we take off a partial position so we let the whole thing run? If it helps with the decision, we could also go back to our charts and note, what has that MFI already done? It's already risen to the opposite extreme. It's gotten up to that 80 overbought zone, starting to tilt out of that. What should we do? I think what we'll do here, how about we see if we can harvest? And now Brown Buffalo says, why not move the stop? That's another possibility. Yeah. We could move the stop where might be an apparently logical place to do that. Brown Buffalo, I like the suggestion. Maybe we'll do that. I was headed in one direction, but let's explore different alternatives, because with trade management techniques, there are a number at a trader's disposal, right? Well, what I do notice here, this support level has held, but if I activate that drawing, push that up here, we may see, is there a new support possibly right around here. It looks like that's around that 236 level. So maybe just going 1% below that, that would put us down around maybe, let's round it off to 233, 234, something like that. Now, how about we snug that stop up? So if we do pull back, it's not as large of a conceptual risk at this point, waiting for us to go all the way back down to there. So how can we move that stop? Well, let's click on drag that thing up there. Let's put that up here. We said 236. Let's put it down at maybe 233-ish. Close enough. I'm going to release that. And what that's doing here is it's just moving that stop up. I don't know if you knew that you could do that, but when you have your order displayed on a chart, you can just click on the little pill, drag that up to the new position, and it gets you get your order confirmation here. So we're moving this up to 233.14. Forgive me a few pennies here. That's actually probably closer to 1% below our support anyway. Now, there's a reminder here that's important. We talked about this the first time, but with stop orders, there's no guarantee that the execution price, the price that's ultimately received, will be equal to or near the activation price. The activation price here being the 233.14 in the event of a strong gap down. But let's send that off, and there we go. So we still have the ability for all of our shares potentially to go up and hit our target. Or if we do stop, there's actually, if we get stopped at this level, it's above our entry price. So we're above the break-even point. There we go. Yeah, a couple of different ways, well, a number of different ways that trade might be managed. Brown Buffalo, right? Okay, great stuff. Let's go on to our next position. We just did Apple. Let's look at Google. Alphabet. We have 30 shares. Purchased those shares at 180 bucks. Pardon me, 185 bucks. Those have sagged a little bit, down like 2.5 or 3%. Let's see what's going on with Alphabet. Revisit the logic of the trade. See if there's anything we need to do with it. But let's come up here to our studies, and we're just going to remove the current study set. And let's add Alphabet. Now, with Alphabet, though, we were using a different candle type, which is a style of chart rather than a study or an indicator that's been added to the chart. So I'm going to go to my styles and load up our style, which was Google, using Heikin-Ashi candles and a MACD histogram. Let's see. Bob says, clarification, the ribbon study I was thinking of was a composite tape index. Okay. Harry says, could you use a floating stop rather than a fixed stop to protect the unrealized profit? Another thing that we might do, right, Harry, we could attach what's called a trailing stop, which trails up as price goes up. It does not go down, so it trails up. A potential advantage of that is it automates the process, makes it mechanical. We don't have to go and move the stop up manually. A disadvantage of doing that is it's not paying any attention whatsoever to what's happening on the chart. So sometimes we can trail up and go just beyond, let's say, a support level. Price comes down, trips the trade out, hits the stop, and then the price keeps going higher, and we're left on the curb. So, yeah, pros and cons. Yep. So what do we have now? Apple. Our Apple position, we have a stop just down here. Took an entry on, we're not on Apple. Good grief. I was sitting there thinking, why am I know I'm unprofitable. Why is this chart saying the stock has gone higher? It's because I'm on the wrong symbol. There we go. All right. Anyway, so here's our trade. There's the support that we had in mind. And what we noted here, what a trader might be looking for with Heikin-Ashis, is looking for a reversal candle. That's where we get a sort of a narrow-bodied candle with a long wick and a long shadow. And we saw that reversal appearing right here. Now, for some, they might also wait for a nice white candle. Now, I believe we had a white candle as of the moment of the discussion. That changed by the end of trading. In any case, we're still just kind of going sideways. We're getting a series of reversal candles. It doesn't necessarily mean terrible things for the stock just yet. Our support is holding, but what the trader would like to see from here is to start to get those white bullish candles again, hopefully even a strong trending candle, which would be the bullish ones that have no lower shadow. But our stop is still in effect. I think we're just going to let this one go. All right. Going to let that work. Oh, and by the way, another part of our trade was at the same time we saw this reversal potentially setting up, we also saw our MACD histogram rising from bright red to dark red. And historically, it's done a pretty good job with this one pretty clear exception right there. There's more of a whipsaw. But it's done a pretty fair job of identifying potential reversal bullish or reversal points on the chart. So we'll let Alphabet continue to work. So that brings us to the point where we need to set the stage for our new discussion of our new indicator. And to do that, let's switch up our candle style here. I'm just going to load up a plain, clean candle chart. There we go. And let's just remove all of our studies. And I want to switch over to the S&P 500 because it's been a rough day. Ranjit says, can you please clarify why we're using different styles? Yes, happy to do that. The reason is, Ranjit, I'm trying to educate my audience as much as possible. It's kind of like a tool demonstration at your favorite home improvement store. We learn how one tool works, and then we move on to the usage of the next one, and the next one, the next one. Because my role as an educator, my job is not here to advise. If I were to stick with one approach from one week to the next, that's okay. But I think that it just has limited educational potential, if that makes sense. Yeah. Okay, so good question. Anyway, so what's going on with the S&P 500? Well, if we were to just use the charts, the candle charts, it's been a great run up. S&P has kind of been tapering off here a little bit, still hitting higher highs. But we got just yesterday, what might we call this if we zoom in on this? When we have a small-bodied candle with no wick and a long tail hanging out the bottom. If this were to happen at the bottom of a down move, we'd call that a hammer. If it happens at the top of an up move, this is actually referred to as a hanging man. Not my favorite title that somebody's ever invented. It's not maybe the title I would have chosen, but it's intended to tell a story. It's intended to give an impression about what the projection for price might be from here. Yeah, it's not good. And actually today is a pretty solid confirmation of that hanging man pattern. We saw another one right back here, a couple of them. So how far might a stock or an index fall after a bearish candle? Well, typically the interpretation for a technical trader is candles are only 1 or maybe 2 or 3 day events. And so therefore they have limited projection to the downside. It might be an exaggeration to say, oh, we have 1 day of selling and therefore we expect a recession, for example, right? Instead, this might just be a signal of a pullback down to possibly a support level. All right, so let's zoom back out. And that support level, where could that be? It might be down here. Could be down there between 5,900 and 6,000. It could be a rising trend line. But speaking of rising trend lines, let's bring in our study set. I call it the trend value momentum study set. It's a combination of 3 indicators that we look at. Now, this is where I do use from week to week, Ranjit, to introduce some semblance of continuity between sessions, because I think there is value in that. We use the same set of indicators to evaluate market conditions from week to week. But again, they're just examples. It's not to say that they are the 3 that everyone should be using. But let's pop up here to our studies again. Let's load up our trend value momentum strategy set. And so this set combines 3 indicators, 2 trend indicators, one that's intended to potentially recognize short-term levels of value and let's say lack of value, overpricedness. How am I supposed to say that? Anyway, yeah, whether there's short-term value apparently present or not. And then down below, we have our momentum indicator. So trend, value, and momentum. So what's going on with trend? For our trend indicators, we have two moving averages. One is a 50-period triangular moving average. It's a smoothed moving average. And a 100-period triangular moving average. They're actually commonly known as a double smooth moving average, but intended to slow down, even be a little bit slower than like an exponential, or pardon me, a simple moving average. Typically, fastest is exponential, simple is next fastest, and then finally the slowest among these three would be the triangular. But the interpretation here might be, as long as our 50 is still rising above our 200, our trend might still be intact, by at least to those who use this as their technical lens of things. And yeah, even with the last couple of days of selling, it looks like our trend is intact. And as a matter of fact, that might also serve as a potential support area. You can see that we've pinched here before, and price came down right close to or touched that longer period moving average. So yeah, no trend reversal on the S&P 500 in the last year through this lens, and I don't think we have one right now. Now, within an intact trend, there might still be times where a trader might be more enthusiastic about joining the trend, other times where the trader might prefer to hold off. And that's where the other two indicators come into play. With RSI, when it dips below 40, now traditionally we'd say 30, but when we have a persistent upward trend, it's actually not very common to get below 30. So for some, they might adjust that up and just say, well, if we can even get below 40, that might be an indication that stocks that are a relative short-term value level. Now, even a stock that apparently is at a value level, it can go lower. But recently, we got down just below 40 and then ticked higher. And that might have been a signal, a second signal, that we're finding strength right around our longer term period, our longer term moving average. Second confirmation, or a first confirmation of an earlier suspicion, I guess. Anyway, and that's panned out fairly well. Although one thing that we pointed out on this, as we're keeping our eye on the S&P 500, some RSI users will also look for this sort of a behavior. When we start to get lower highs on our indicator, at the same time, our index or stock is making higher highs, it could signify that that trend is really starting to weaken in ways that might not be entirely obvious. So what might be the confirmation that of a potential reversal that this RSI seems to be warning about? Well, if the trend breaks down. That hasn't happened yet. That's one way that we might identify confirmation of that. Until then, the weight of the evidence might be still leaning toward bullishness, just short-term, maybe overpriced levels. Now, finally, we have our momentum indicator. When we get a deep dive on that MACD, rising then from bright red to dark red, for some, they might see that as possible important reversal points, bullish reversal points on our index, or if we were looking at a stock, it would be the same logic. So our last really deep dive was right back here, and that was a pretty good reversal point. We went a little bit lower, but most price trading has been above that, or most trading has been above those levels since then. Let's see. Let me see what comments have been coming in. AJ says, how do you know the trend is broken down? AJ, through this particular lens, the trader would simply be looking at our green line, our 50-period triangular moving average, to dip below the red line. That might just mean that our intermediate term trend has weakened enough that it might be applying drag on the longer term trend. Even that, though, nothing's a confirmation, nothing's a guarantee of what an index is going to do from that way forward. But for some traders, they might just say, you know what, it's enough for me. I'm just going to hold off before placing any trades. Now, I'm going to be moving on to the ribbon study here in just a moment, but going back to that MACD, the one final point that I wanted to make about the MACD is that some of you might be looking at this and saying, well, Cameron, so there's what's called a divergence. Our RSI indicator is diverging from price, which might be bearish. Isn't there also a divergence on the MACD? And while I can say technically yes, there is, I think for most traders, or for many traders of the MACD, if they use uh, these sorts of divergences at all, they may not assign as much weight to those as maybe as we assign to something like the RSI, because they're so common. Look at this. Here's a divergence here. Here's a divergence here. Here's a divergence here. They don't happen very often on RSI at all. And so when they do happen, they might attract a little bit more attention than something that's so comparatively routine on the MACD oscillator. Okay? So bottom lining all of this, trend seems to be intact. Our two oscillators maybe showing a little bit overpriced at the moment. So how might the trader react to that? Well, maybe just wait for our oscillators to dip a little bit. Maybe they're price to come down closer to our trend line. And if we start to see a reversal on those, that may be, through that lens, an optimized entry point. Or it might be a signal, hey, S&P looks good. Let's go look for stocks and see if they look good as well. All right. Kenneth? Okay, yep, sounds good. All right, so let's move on to our new indicator. Now notice we do use quite a few here. If you're not familiar with these indicators and you're thinking, oh, that looked intriguing, Cameron, that thing you did on Google or on Apple, on Progressive, you can learn those. Just make sure that you are following along with our archives on our YouTube channel. So if you haven't done this already, make sure that you're subscribed to our YouTube channel. You can go right down between the video or right down below the video right now. Click on the subscribe button. It doesn't cost anything to do that. It only takes a second. But our YouTube channel is where we host our previously delivered webcasts in these nice little playlists. So I could click on playlists and I could just scroll down until I see my face where I'm talking about advanced charting techniques. And if I click on view that full playlist, we can see there's my discussion of Heikin Ashi candles. There's the TTM wave indicator. We talked about something called Woody's Commodity Channel Index recently on the request of another attendee. And let me just point out this one other. There's our trend, value, and momentum chart trading system discussion. All right, but let's go back now and talk about our new indicator. So we're going to clean off our studies. And I'm going to switch up my chart, and I want to use Walmart as our example. Walmart's having a rough go right now, okay? Tough earnings announcement reaction here. Apparently, Walmart shareholders not thrilled with what they heard. In any case, I'm going to use this as our indicator discussion. And I want to set the stage conceptually for a ribbon study. Now, how many of you, I know that almost everybody here is familiar with moving averages, and especially the simple moving average. And actually, the ribbon study is built directly on simple moving averages. But how many of you have heard of using moving averages in combination, much like I just did with triangular moving averages, where crossover events can be significant? As an example, probably, at least in my experience. Oh, and Joey says, this is your first time to this class. You think you might need to binge watch the playlist over the weekend? Oh, that might be fun. Yeah, do that and you'll have a lot of new tools in your toolbox. One thing I'll tell you, Joey, don't be intimidated. Ooh, I've got to pick the right set of tools. No, it's kind of like if you go to a gym for the first time and you see everybody using different equipment and you think, I've got to use the right one or I'm never going to get fit. It's probably not true. Just pick one, get good at it, learn how it works, and see if it works for you to accomplish what you're trying to do, okay? But in any case, yeah, enjoy going through those. But I'm going to add what in my experience has been possibly the most common moving average crossover system. And that's a combination of a 10-week and a 40-week moving average system. So let's come up here to our Edit Studies Flask. I'm going to type in simple for simple moving average. Let's choose that from our menu of potential indicators and click it twice so that we can add two of them. The first one, I'm going to change to a 10 because we're going to be looking at 10 weeks. And that one's going to be shorter, so I'm going to give it a hotter color. Let's change that maybe to red. Click OK. And then I'm going to change the second one to 40 weeks. So let's change its length to 40. I'm going to leave that green, but I realize that some out there can't really see the difference between red and green. So let me make that one also thicker. There we go. So let me click OK and click Apply. So the thick one is our longer term moving average. The thinner red one is our shorter term. And it's the interplay between these two that might be interesting to a crossover trader. Pardon me. Maybe what I'll do here, let's switch this now out to a weekly chart, because this crossover system, at least in my experience, the most common application is on that longer term time frame, 10 weeks versus 40 weeks, which is basically 1/4's worth of trading on an annualized basis to close to a year, very roughly speaking. So for a crossover trader, what they're looking for here, for bullishness, they're looking for the shorter term moving average, in this case our 10-week, representing a shorter term, I keep saying shorter, putting emphasis on the because there can be technical definitions of a short term and long term. I'm not getting into that. We're just talking about one is shorter than the other one, okay? But our shorter term moving average, when it's below the longer, it might indicate to our technical trader that there's weakness in the trend. And they're waiting for sufficient strength to return to that trend where it's dragged that shorter term moving average has started to rise sufficiently that it actually crosses over our longer term. So we have exactly one of those events here. I actually wasn't planning to talk about this using Walmart, but I thought, oh, well, that's where we are. Let's use it. What do we call that? Oh, Dave says, how do you know it's weeks instead of days? Good question. Right up here, there'll be an indication when we're on days, it'll say D. When it's on weeks, it's abbreviated to WK. Okay? But when we cross over the faster goes up above the slower, what do we call that? This is another one of those scenarios where some trader had a flair for the dramatic in the naming of these. This is known as a golden cross, Chris, be exactly right. Yeah. All right. That sounds like a guarantee. It's not a guarantee that that price is going to go up from here, but it tells the intended story. It's bullish in the interpretation, the traditional interpretation of this. What do we call it when we get a crossover in the other direction? Here's a little wimpy one where we duck down below, we got a whipsaw and it turned right back up above. This we'd call a death cross. Yeah, talk about dramatic. That sounds like the stock is about to die. In this case, nope, perfectly healthy. Off it went again. So in this case, we got a death cross followed by a pretty quick turnaround just a couple of weeks later, golden cross, and off the stock went. So if a trader is trading this, they had one little frustrating event right here, but otherwise, hey, for Walmart, that's not a bad approach. Getting in here, out back in right there, and off it goes. And the trader just sticks with that. But these crossovers can be potentially important signals to traders who use moving averages in combination. Well, this is using two. And we know that, hey, if something's good, isn't more better? Sometimes it is and sometimes it isn't. But yeah, the indicator that we're going to now learn uses crossovers to kind of an extreme. Let me clean this up again. I'm going to remove all of our studies. I'm going to switch this back to a daily chart, and I'm going to now add our ribbon study. So let's choose the ribbon study from the menu, click Add Selected. Now, as we do, before I go, well, actually, let's go ahead and apply it there. What you'll see now is we have a whole bunch of lines here. It's a bunch of moving averages, basically. But I'm going to click on the little gear and show you some important elements here. First of all, we have 50 and 200. So what that's telling me is my shortest moving average that's being displayed here is a 50. In other words, that's our fastest one. Our slowest moving average is a 200. Now, in between those, there are 6 other moving averages that are spaced exactly equivalently to one another, right? They're just spaced out, starting at 50, going to 200. And just so you know, I've done the math on this in the past, and I know that's going to be actually in 21.43 period increments. 21.43. Yep. So our first moving average is going to be 50. Our second one is going to be 71.43, rounded down to 71. Our third one is going to be, what would that be? 92.86, rounded down to 92, and so on all the way up to 200. Okay? Now, each of those moving averages are going to have a title. RS1, RS2, RS3 is what we call them, just meaning ribbon study 1, ribbon study 2, ribbon study 3, ribbon study 4. And they're going to be colors. So the orange one, you'll notice they range by default from orange to yellow. One thing I'm going to do here, just to make it a little bit easier, I'm going to make these a little bit thicker. Typically, in a typical approach to trading the ribbon study, RS1 and RS8 might carry the greatest weight. So I'm going to make those thickest. So instead of being these little pencil thin lines, 1 out of 5 in thickness, I'm going to make RS1 a 5. I'm going to make RS8 a 5. And then I'm going to scale those down. Let's go for a 4 on this one. Let's go down to a 3. Let's take this one down to a 2. And then let's start to work our way back up again. 2, 3, and 4. This is just to help things visually. Okay, but let's click OK, and let's click Apply, and click OK again. So John says, oh, John, you're asking a good question. This is a question that anybody would naturally ask about any new indicator they learn. How often is this accurate? Give me a percentage. I don't have a percentage to offer because literally, John, the data set is vast and ever changing. And it depends on time frame, it depends on security, it depends on market conditions. There are just so many different ways that we could slice that thing up. Anyway, but Thaya, yeah, how often does it work out, Crispy? Exactly. I don't have a number to provide, nor would I be inclined to provide one if I had one, because I don't want to give the impression that one indicator is better than another. What we typically do is just show how they are built, how they might work, and then leave it up to each trader to do a little bit of exploring and see if it makes sense to them and if it might play a role in their portfolio going forward if they use technical indicators at all. But in any case, so here's our Walmart now. So what did we just learn? Well, we learned that our fastest indicator, which is the one that's going to hug closest to price, is going to be a 50-period moving average. Our slowest one, the one that's going to tend to take the longest to move toward price, is going to be our 200-period moving average. And then there are essentially slices of moving averages in between. These are going to typically be somewhat non-traditional moving averages, although there's a customization we might make in just a moment. But how might the trader, now that we've seen the construction of these and we know how they're built, and hopefully it made sense to you. As a matter of fact, I've made a little bit of an equation. If this helps you know exactly how these are built, first thing that we need to do to build one, if we want to build it manually, calculate something that I would call the moving average increment. There we go. Which is simply the slowest moving average minus the fastest moving average. And how about I throw MA in here? So we take the slowest moving average, in this case, the 200, fastest is 50, subtract the fastest from the slowest, that's 150. And then we just divide that by 7. That gives us what I'd call our moving average increment. Now, the next step to calculate this would be to take our moving average increment and add that to our fastest moving average. Okay? And then we take, as a third step, we take our, that would actually give us our, let's say our RS2. In other words, our ribbon study number 2. And then we just continue with that to calculate the rest. So I know that sounds like a lot, but if we were to implement this, let's just copy this equation, paste it right down here. Our slowest moving average is 200. Fastest moving average is going to be 50. 200 minus 50 divided by 7 is, in this case, 2143. So we take that moving average increment, 2143, add that to our fastest moving average, which is 50, and it gives us our next moving average called the RS1, which is 7143. And then we just round that down to the next largest, or to the next whole number. In any case, that's how these are calculated. So how might they be traded? It's simply there are two basic approaches to this. The first thing that a trader might wait for is for, and let me bring up another stock to use as an example. When these moving averages start to converge, they start to squeeze together like we see right here, what might that mean? It can mean that the stock is primarily going sideways. The long-term moving averages, the intermediate-term moving averages, the slower-term moving averages are all in basically the same area. And this may be a signal, ooh, there might be something happening with the trend. Trend might be reversing. And when a trader is looking for an entry using this, they might just wait for that reversal to sort of work itself out. So a common signal here is to wait for these to squeeze together, and then for our fastest moving average to start crossing up above the others. So right here could be a signal that we're coming out of this squeeze and we're starting to move higher. Okay, there's an entry. Where might the trader exit? Well, if we've advanced beyond that squeeze and the fastest moving average starts to cross down below the next, that might be a signal for exit. Thaya says it looks confusing. Yeah, really the function of lots of the ones in the middle is just to assist with the identification of squeezes, essentially, right? And then an entry might be taken after the fastest one starts to reverse and starts to behave bullishly again. It's rising, starting to cross up above the others. Now, for some traders, they might actually add to a position as it crosses up above maybe RS2 is the first signal, RS3 the second signal, RS4 the third signal, and so on. Okay, so as an example here, let's have a look at ABBV. ABBV, we just had a recent squeeze. You can see all of those sort of converging, and particularly the fast crossing down through the rest. When that hits a low and starts to rise again, that might be our signal. And that says, would Bollinger Bands or Keltner channels show a similar signal? Could be. It's actually a very similar concept. But yeah, we see another example here where we got a squeeze. In this case, the fastest didn't get all the way to the bottom, but started to rise up and cross over the one just above. Okay, so that could be an entry. Where might be an exit? Well, when our fast starts to cross back down below the second one, the RS2, right? So what I'll do here, I'll just place it off camera, just in the interest of time. I'm going to go buy this stock, and then we'll wait to see if we get an ultimate sell signal, see if this pans out. Now, if price reverses, or if our RS1 starts to cross back down below RS2, trade may be over, just within a couple of percentage points below that. So that might be a trade management technique to the downside. But guys, with that, there's an introduction, a quick introduction, but really a fairly straightforward indicator that can look a little bit complicated initially, but looking for squeezes and then crossovers of RS1 versus RS2 to initiate and maybe manage trades in the future. So everybody, time for me to let you go. Enjoy your weekend. Thanks for giving me your time today. As I let you go, I just want to give a final reminder. Make sure that you have subscribed to our Trader Talks channel if you haven't done that already. Just go down and click on the subscribe button. It literally only takes a moment and it doesn't cost anything. But that's the best place to find our previous, it is the place where we house our previous webcasts. Also, make sure that you're following Ben and me on X. You can find Ben there at Ben Watson CS. You can find me on X at Cameron May CS. I want to thank everybody for already clicking the like button. That's very much appreciated. 200 people watching. Already 50 have already clicked that like button. Thanks for doing that. We'll follow up on this trade and others in the upcoming webcasts. I will look for you in future webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.